Is your dividend portfolio underperforming the market? You want the income, but you're tired of seeing your principal stay flat while the Nasdaq flies. Well, there's a much better way to do this. By mixing the stability of JEPI with the explosive premiums of JEPQ, we've created the ultimate income engine. In a previous video, I spoke about JEPI and what makes it a very strong ETF, but allow me to go into JEPQ for a minute just by itself before I go into why blending JEPI and JEPQ might be the tool you're looking for. So let me start by defining what JEPQ is. So the ticker JEPQ, or JEPQ for short, that stands for JP Morgan Nasdaq Equity Premium Income ETF. And looking at the core, it owns the biggest tech companies in the world, the Nasdaq 100. So we're talking companies like NVIDIA, Apple, Microsoft, Alphabet. And its goal is designed to give you a piece of that tech growth. But instead of just waiting for the stock price to go up, it pays us a pretty massive monthly dividend, which currently stands at over 11%. So this is the secret sauce of JEPQ. So they sell covered calls specifically via equity-linked notes or ELNs, which I covered in my previous video. So I'm going to give you an analogy. Think of JEPQ like owning a high-end apartment building in Silicon Valley. You own the building, which are, in this case, the tech stocks, but you're also collecting rent every month from the tenants, and that's the option premiums. So even if the building's value stays flat, you're still getting those rent checks. And the volatility is good. So when the market is choppy or scary, the premiums or the rents, if we go by the analogy, they actually go up, and that is why JEPQ's yield is so high right now in 2026. Now, let me balance that out a little bit, because if, let's say, a company like NVIDIA goes to the moon and the Nasdaq goes up by 20%, JEPQ might only go up by 12%. Why? Because they sold that upside to provide you with income. So bear that in mind. Yes, the yield is high, but it's going to be at the expense of the potential upside if the Nasdaq really goes up. Now, I've taken this from the most recent prospectus of JEPQ to let you know what the mix, if you will, is of it. So NVIDIA makes up 7.8%, Apple 6.8%, Microsoft 6.3%, Alphabet 5.5%. Those are the four most utilized stocks in the ETF. You're also looking at companies like Amazon, Tesla, Broadcom, Netflix, and Advanced Micro Devices. One more thing that I have to mention is that's really important that a lot of investors miss is the expense ratio. If you look at JEPI and JEPQ, it's actually the same, which is 0.35. It's inexpensive, but the bottom line is you're comparing apples to apples, so you're not trading one higher class of investment product for another. You're doing an equal match when doing the blend that I'm going to be talking about shortly. I did go in depth on JEPI in another video, but to give you an idea right now, the dividend yield is over 8%. So let's set up why the J pair, if we can call it that, blend, JEPQ and JEPI. So we want, let's say, 10% yield, but we don't want the tech heart attack of being 100% on JEPQ. On the flip side, JEPI is safe, but 8% yield might feel like you're leaving money on the table in this market. So the solution is the 50-50 blend. So you're basically going to pair the S&P 500 stability of JEPI with the NASDAQ 100 octane of JEPQ. And we create a sweet spot portfolio that aims for double-digit income with a much smoother ride for your principal. Now, looking at the split, logistically, this is dead simple. So for every 1,000 you invest, as an example, 500 would go to JEPI and 500 would go into JEPQ. That's the blended strategy. And this gives you exposure to over 200 of the world's most dominant companies. Looking at the monthly payout, both funds pay out in the first week of every month, usually within the first 3 to 5 business days. So you're going to see two separate deposits hit your brokerage. It's like getting a mid-month paycheck, but it arrives before your mortgage is even due. So let's look at the actual 2026 numbers. JEPI is sitting at a little over 8%. JEPQ is a beast at 11.58%, and this is based on the latest 30-day SEC yield. So the blended result is your portfolio yield landing at 9.79, almost 10%. And let's say you have 100,000 in this blend, you would be generating 9,790 a year, which is roughly $815 every single month. If you were to compare that to the 1.3% yield of the S&P 500, you're making roughly 7 times more cash just by switching to the blend. Now, let's talk a little bit about the tax trap. And being an investor myself in these products, that's a reality we gotta face. So nobody's gonna talk about this, or not many people are gonna talk about it, but most of the income from JEPI and JEPQ comes from the equity-linked notes. And in the eyes of the IRS, this is basically ordinary income, not qualified dividends. So what that means is you could be taxed at your highest income bracket, whether that's 37% or lower. You gotta take a look at this is gonna be income. So if you hold this in a standard brokerage account, you're gonna be giving up a huge chunk to Uncle Sam. And the pro move, quote unquote, would be to talk to a CPA about tax advantage accounts that you can maybe encapsulate this dividend income into. This information goes beyond the scope of what the channel sentiment is. Our focus really is on covered call ETFs, not accounting advice. But I do want to be very fair and transparent with you that this is going to be treated as ordinary income. So please bear that in mind. So in conclusion, this blended ETF basket is going to give you low fees, 0.35%, monthly payouts, and exposure to over 200 premium stocks. And that is how you turn a flat principal into a retirement machine or income machine. Thank you so much for watching this video. If you liked it, please hit the like and subscribe button. And remember to share this video as well. The goal of this channel is really to focus on covered call ETFs because they've been getting a lot of notoriety, and it's a product that, for the right person, can really make a difference. Thanks so much again, and I will see you on the very next episode.